Hello all, this is Deepa Sachanandani from Century Financial and I welcome you all to yet another session from Century Financial. In today's webinar, we'll be talking about the earnings season and how we can trade during the current earnings season. Now, it's important because during the earnings season, we see a lot of volatility within the stocks and particularly in the stock market itself. So, in today's webinar, we'll be talking about how to read a company's earning reports, what are the strategies that we can implement during the current session, and how we can trade a particular stock during its earnings. It's important to understand that whatever we discuss in today's session, we are ultimately a part of the markets. So markets can move in either direction. So whatever we discuss in today's session, it's important that you take a one-on-one session with your consultants and understand your risk associated with the trade, and only then move forward with the trade. There is no guarantee in a particular market. So when we are talking about all of these ideas and strategies during the session, it's important that you understand the risk associated with your particular profile and go for a one-on-one consultation with your consultants and take proper advice and understand the risk involved. Without much ado, let's quickly begin and let's just understand first that what is an earnings report. Basically, in today's session, we'll be covering how do you read a company's earnings, and what are the various factors that we need to consider when we are talking about a company's earnings report, and why is it important to keep track of how the company is reporting quarter on quarter or year over year. So what is an earnings report? Now, ultimately, see, when you invest in a particular stock, you are basically entitled to receive a report on how the company has been doing quarter on quarter or year over year. It's basically nothing but a report card. An earnings report is just that. The company will come out with figures such as how did they do in a particular quarter in terms of their revenues, in terms of their income, and so on and so forth. So it just gives you an idea as to how the company has been growing, because if we have invested in a particular company, obviously it's important for us to know as to how is the company doing. When a company reports their earnings, they basically come out with quarterly reports as well as with an annual report. So every 4 months, the company will be reporting their earnings, and the quarterly reports are called as 10Q reports, whereas the annual report is called as the 10K report. So when it comes to the earnings, why is it necessary that we need to read the earnings report? So, as an experienced investor, it is important that we are trading in stocks day in and day out. But it's important that you take a step back and understand how is the company actually faring and what is it reporting, and take a deeper look into the company before you actually purchase that stock or sell the stock. So it's important that we look into that as well. So on this page out here, you can see this is just a sample earnings report. So this is nothing but from General Electric's GE sample earnings report. So like you can see over here, the company is talking about their financial resources, their risk factors, their legal proceedings, the financial statements, and so on and so forth. It's even talking about the different areas that it is into. So it just gives you a holistic picture, and you get to know how the management has been performing, what is the management's view about not only about the company, but about the cycle of the economy, and so on and so forth. So you get a lot of information when a company comes out with its earnings report. So it's important that we look into most of these parameters. Now, when we look at a company's earnings report, so obviously there is lots of information available in the report, like I said. But when you're analyzing a company's earnings report, the most quality time that you will be spending will be on the income statement. Within the income statement, we will be looking at the total revenue, the cost of sales, gross margin, operating expenses, the net income, and most importantly, earnings per share. So when we look at each of these items, what we'll be analyzing and what we'll be seeing when a company reports these numbers. So by itself, this number will mean nothing to any of us. We need a benchmark or a comparison that needs to be done to make some sense of these numbers. So when a company, I'm trying to keep it as basic and simple as possible. In case if you have any doubts or any questions, please feel free to ask. We'll try and make this interactive. So there are many who might not be trading in the market. So I'm trying to keep this as basic and as simple as possible. So in case if you have any questions, please feel free to ask. I'll answer it there and there, or maybe later towards the end of the session, and we can take it forward going from there. So coming back now, like I was saying, when a company is reporting these numbers by itself, these numbers will not make sense unless and until we draw a comparison. So against what can we make this comparison? Now, say, for example, a company is now coming out with their earnings this quarter. Take, for example, Apple is reporting its earnings this quarter. Now, we'll get to see what were the kind of sales that Apple did, what were the number of iPhones that they sold, what was the revenue generated, what is the kind of profit that the company has made. Now, there are two comparisons that you can make. One, obviously, you'll see how did Apple do in the previous quarter and comparatively how the stock has performed in this quarter. So, how has the net profit of the company grown compared to the previous quarter? In this case, we call it as quarter on quarter. So what we'll be doing is we'll be comparing the net profits for Apple for Q1 2022 versus Q4 2021. So in case if the profits are higher than the previous quarter, then you get to see that, all right, the profit margin has gone up, the profits have been increasing, which is obviously a positive sign. On the other hand, another way that we can compare the earnings, for example, in terms of the net income or the revenues, will be year over year. So you will be comparing the sales or the profit for this quarter, for quarter Q1 2022 with Q1 2021. So what happens over here is that why would one do that? Say, for example, a stock like Apple, when we're sticking to Apple, so what happens is Apple comes up with its new versions of iPhones every September. And when it does that, obviously there's a greater demand for their iPhones. Everyone wants to buy the latest version. So when you see that, when there's a new iPhone in the market, generally the sales pick up in. So we generally for Apple, you will see that between October to December and even July to September, the sales are much more higher. So obviously, it would make more sense for you to compare how Apple stock, how did the company report in the last quarter of 2021 versus the last quarter of 2022. So you need to ensure that you're comparing the same quarters. So we'll just take this forward. I also have an example of Apple's earnings report on the slides ahead, so it will get more clear once we actually see the numbers. So let's take a look at, like we was talking about, the income statement. So a plain and simple income statement is basically what are the profits that are generated by a particular company in that particular period, be it for a quarter or be it for a year. So when we're looking at an income statement, it is basically just the sales that the company did, you minus your expenses, and you'll be left with the profits. This is the most basic. I've tried and explained this in a layman language. Of course, there are many more items that we see in an income statement, but this is just the crux of it. We're looking at revenues minus your expenses, and you have your profits. So it just tells you how much money a company made in a particular quarter or a particular year, depending on the period that you're comparing it with. So now this is, we'll start with total revenue. So when we talk about total revenue, this is how Apple has performed in the year 2020, December 2021, quarter ending December 2021. And we've compared it, like you see, with the quarter ending December 2020. So what this gives you is, for example, in the year ending, in the quarter ending December 2021, Apple recorded revenues of 123 billion. Now this marked a growth because in the previous quarter, December 2020, the company recorded revenues of 111 billion. Now, why is this important? Why do we see it on on a year-over-year basis? In this case, we are not looking at quarter-on-quarter. Let me try and explain you over here on this slide. So, as you can see, in the quarter ending December 2021, Apple recorded revenues of 123 billion. Now, if I were to compare this with what happened in the previous quarter, you can see Apple reported revenues of 83 billion. So the jump is significant. I mean, if you look at on a quarter-on-quarter basis, we see the company actually reported almost 50% jump in revenues, and that would be like significant for a stock like Apple. It's a mature company at the end of the day. If it is reporting a 50% revenue jump, that would be significant. But if you were to compare it with what it did in the same quarter 2021, then you will see the revenue jump is nearly 11%. So from 111 billion, $11 billion, it went up to 123 thousand billion dollars. So the jump is just 11%, and that is how we need to compare, because majority of the sales for Apple comes in the latter half of the year, and we need to consider that parameter. So for certain companies, we'll be comparing the revenues and the incomes on a quarter-on-quarter basis, while for certain companies, you'll be looking at on a year-over-year basis. So this is something I hope I've tried and made it very clear. I hope you'll have understood this aspect. For certain companies, we will, if they're cyclical in nature, so in that particular aspect, we look at year-over-year growth, and otherwise we look on quarter-on-quarter growth as well. In some companies, we look at both the parameters to see how the company has been growing. Obviously, if your quarter-on-quarter growth is positive, if your year-over-year growth is also positive, it's a good sign. That means the company has been doing well, and it has beating its expectations. Another parameter, actually, which is very important when we are looking at earnings, is that we generally compare the earnings of a particular company with. Okay, I'm sorry, but there is someone who cannot hear me. Is this can others also give me a thumbs up if I'm audible or not? Can anyone just confirm if y'all can hear me or not? Because okay, so I believe Niranjan, the problem is just at your end, maybe. Maybe you could just refresh the page and then it could get clear. All right. So moving on, when it comes to the earnings, like I was talking about, so we, okay, yeah. Once you refresh the page, probably it might just get clear. So I hope that that issue is solved. All right. Niranjan, actually, others can hear, so I believe you just need to refresh your page, and that could solve the issue. Right. Coming back to where we were. So apart from this quarter-on-quarter comparison and year-over-year comparison, companies always give a guidance of how they expect the revenues or their profit margins to be in the coming quarter. So they will give you a target that we are expecting the company, to achieve a net profit of so and so in the next quarter or even in the next year. So that's called as the company giving you a guidance. And generally, based on this guidance, the Wall Street's they have an estimate of what will the company report in a particular quarter. Now, if Apple comes up with a revenue figure that is higher than the Wall Street estimates, or than it's also called as the consensus estimate. So if Apple comes out with a revenue which is higher than the estimate, obviously it's a good sign. So, there are three checks that you need to see. If it's on quarter, if it's positive, on year over year also, if it is positive and higher, and if it's also beating Wall Street estimates, then most likely or not, the stock may end up doing well. Of course, there are many other parameters. You have to see the kind of economy that we are into and so on and so forth. But these, just a general rule of thumb, if these aspects are positive, there's a good chance that your stock will do well. Now, another way when we look at a company reporting their revenues, there's also called something called as segmented revenue. So we'll see, for example, this is Apple's revenue picture for the latest quarter. So what it is showing is that how much revenue did Apple achieve by selling iPhones? How much revenue did they achieve by selling iPads, Macs, and so on and so forth? So obviously, we can see the iPhone revenue has gone up compared to on a year-over-year basis. The Mac sales have also gone up. In terms of services, which consist of their cloud division as well, that has done really well. In fact, we see a great percentage jump in terms of their service segment. So this basically gives you an idea that, all right, cloud computing is one area, cloud services is one area which has the potential to grow a lot in the future, and Apple has been capitalizing on it, and this is one area where the sales have been higher and the percentage growth has been higher. So this is a positive aspect. So many a times when you look at the revenues, it's important that we look at from which segment the revenue is coming from. So that gives you a better idea. So for example, if the company has started generating more revenues in a particular sector which will not generate much growth in the future, then that is probably not a very good sign. On the other hand, on the contrary, for example, Amazon currently generates almost 15% from its cloud segment. So that is one area which is, the future and is making a big move out there. So if Apple is, if Amazon is increasing its focus on the cloud segment, then that is a positive sign. So this really gives you a great detail about where the company is heading into, and which is why it is important that we look at the revenue in detail as well. But it's important that we understand that although revenue does give you a big picture about the company, it is not one of the best indicators. Why? Because it will not account for what is the cost of bringing in that kind of revenue. So it's important that we look at what the cost undertaken by the company as well, and finally look at the net profit figure as well. Nonetheless, it is a very important segment. I mean, almost the second most watched parameter during the earnings season. So we'll take this forward. Now, this is how actually, this is from Apple's latest earnings report that we have. In fact, the company is going to report its earnings this week itself for the next quarter. So, but this is how it reported last year. So you can see this is generally when a company is reporting. Apple has reported its earnings for the last quarter and compared it with the same quarter last year. So December 2021 versus December 2020. So you can see the sales that were generated from the products, whereas the sales that were generated from the revenues. And below the statement, they provide a detailed bifurcation of each segment revenue, which was already covered on the previous slide. Now, moving forward to the next thing, we have something called as cost of sales. Now, what is cost of sales? It is nothing. Just for example, we were speaking about Apple. So what is the cost of manufacturing those computers that were sold in that particular year, or the cost of manufacturing those iPhones that were sold in that particular year? That is as simple as it is, the cost of goods sold. The lower it is, the better for the company, because uh, the lower the cost of sales, higher the gross margin of a company. Gross margin is what? You basically have your net sales minus the cost of manufacturing it, and you divide that by your net sales again, and you'll get your gross margin. So the higher the gross margin for a company, the more capital a company is retaining on each dollar of sales, which can then be used, for other cost or other debt obligations that the company has. So the higher the gross margin, the better it is for the company. Now, Moving forward, then we have something called as operating expenses on an income statement. Now, operating expenses are also given a lot of importance. Why? Because many a times the gross margin of a company can be amazing, but when it comes to their day-to-day expenses in terms of selling, general and admin expenses, or their research and development expenses, we see that there's this it takes away the major chunk of the company's profits. So the lower the operating expenses of a company, obviously it's better. And during the earnings season, if a company comes up with an earnings report and it's the news states that the company's margins have improved because the company cut down its operating expenses, that's generally viewed as a big positive by the market participants. All right. So we'll moving forward. So this is how the operating expenses looks on the balance sheet. On the income statement of a company, we have the net sales. We minus the cost of sales. So we get the gross margin from which we minus the operating expenses, and we receive the operating income. Now, coming to the most important bit, so we have the net income, and from net income, we come at a particular factor which is called as the earnings per share, which is the most important, which is on the next slide. We'll first cover what is net income. It's as basic as we discussed. Your total revenues minus your total expenses, you'll arrive at your net income. Again, if your net income is higher quarter on quarter, year over year, it's a positive sign. It means that the company has been doing well. Also, if it's above Wall Street expectations, above the consensus, it's again a big positive. Now, so this is how your income statement, net income will look like on an income statement. Coming to the most important part and the most watched factor when it comes to the earnings season, or when a company is reporting their earnings, is the earnings per share. Now, what is the earnings per share? It is nothing. It is basically your net income minus the preference dividend, because preference shareholders do have a preference over the dividend of the company. So you just remove that net income minus your preference dividend, and you divide it by the total number of outstanding shares. So it's basically, how much. So if you invested, say, if you're holding $1,000 in a of say Apple stock, and if you're holding 1,000 shares of Apple, so you will like to see how much the company has made per share that you're holding. So it's basically for $1 that you invested in the company, how effectively the company has utilized your funds. It's important to understand that the EPS is not the same thing as dividend. Dividend is something that the company pays out quarter on quarter or on a yearly basis, or some companies may not even pay out a dividend. So it depends upon the company's, the dividend policy that the company follows. So earnings per share is not the dividend. Dividend is something that you receive. Earnings per share is just giving you a picture that how effectively the company is utilizing your funds. So it's basically a proxy of how the company's financial health is. So it also says that if all the profits were paid out to the shareholders, earnings per share is the portion of the company's net income that would be allocated to each outstanding share. So if the company is, say, finally, if they want to distribute all the money that they've made in a particular year, then earnings per share is what the client would have earned and would have received. So I hope this was clear. Earnings per share is not the same as the dividend as well. Now, when we are looking at earnings per share, again, three factors. You compare it quarter on quarter, year over year, and most importantly with your Wall Street estimates or with your consensus estimates. So if your earnings are coming above the estimates, most likely the stock will outperform and will do well after it reports its earnings. And if it is not meeting the estimates, if it's coming in below the estimates, then most likely the market will punish the stock as well. Now, another factor is PE. Well, this is not much related to the earnings season as such, but generally, when you talk about the earnings per share, another factor, a parameter that is analyzed by most analysts would be the PE ratio, wherein we compare the share price with the earnings per share. So we basically try to see how expensive a stock is in with regards to its earnings per share. That means how many times a company's stock price is trading per earnings per share of the company. So, for example, when a company has a very high PE ratio, many a times it might be considered as the company is overvalued. But another way of looking at it is that many people are willing to pay a premium for that particular company. So maybe the company is they're expecting a significant growth in the company in the future. So which is why they are willing to pay a premium for that particular company. On the other hand, if we have a very low PE, one way of interpreting it would be that the company is undervalued and it would make sense to buy the stock. Or another way would be that the company that investors do not foresee good potential in the company and hence they are not willing to pay or give it a high valuation. So it's important that you analyze the PE appropriately. And when you're comparing when you're comparing a PE ratio, obviously you need to you'll not know by itself if the PE is high or low unless you compare it to others. But it's very important that when you're comparing PE ratios, that you compare apples to apples. I mean, so you cannot compare a Coca-Cola company with a Microsoft because they are in different businesses. They'll have different PE valuations. So this chart basically out here is comparing the PE of the beverages company in the United States. So we can see Coca-Cola has a PE of 29. On the other hand, PepsiCo has a PE of 30.5. So more or less, most of these companies, the average PE ratio is 28.5. So Coca-Cola compared to its current PE of 28.97, we can say that it is fairly valued. So this is how you look at PE ratios. Um, all right. So now coming to the key question as to how do we interpret the earnings season. So there are three key factors that we need to look at. Most importantly, we have the earnings per share, followed by the revenue and the forward outlook, and that is basically the company giving out its guidance. So on each of these parameters, like I have been mentioning, if it is we need to compare quarter on quarter, we even need to compare year over year, and we need to see if it is matching the Wall Street estimates or beating the estimates. If it is beating the Wall Street estimates, it's a positive sign. Now, most importantly, we also need to give a lot of weightage to the forward outlook. Like I said, when a company is reporting their earnings, they will not only talk about what happened in the previous quarter, but they'll also give a guidance or a forward outlook as to what they expect in the next quarter. So that is what we're talking about over here. That is the forward outlook. Now, this is just an example. Recently, Delta Airlines came out with their earnings, and the company actually reported a loss of $1.23. So that is $1.23 per share. Delta Airlines actually reported a loss. So, I mean, I'll just do a poll right now and I'll ask, I mean, so when Delta Airlines actually reported a loss, what do you think happened to the stock price? Did it actually gain after the earnings or did it fall? Let's quickly, I'll share this poll and let me see what do you believe. Okay, so we have our responses wherein 70% of the audience feels that Delta Airlines gained on their earnings, whereas 30% feel that the stock fell on earnings. So I must say that most of you all have got it correct. Now, despite the company reporting a loss on its earnings quarter, like the stock did well on earnings. Now, the reason was, I mean, I think it was available on the slide as well. So when the company reported a loss, it reported a loss less than what was expected by the markets. So the markets were expecting, Wall Street estimates was showing or suggesting a loss of $1.27. So the loss came in below estimates, which is why Delta Airlines, or actually outperformed, and I mean the stock rallied after the earnings. That was not the only reason. Of course, revenues also came above expectations. But the most significant reason why Delta Airlines did well was because the company stated that they are expecting uh, the company to return to a profit in the current quarter. So previously, for the last few quarters, obviously because of the pandemic, the company was not doing well, and it was actually reporting losses. So this is a big positive one. They are stating that they are expected to return to profits in the current quarter. So on expectations, the stock rallied. Secondly, the company started comparing itself to the year 2019. So, like we were stating that quarter-on-quarter comparison or year-over-year comparison is needed. In this case, Delta Airlines was comparing itself to the year 2019. Why was it doing so? Because 2020 and 2021, if you compare how were the revenues compared to 2020, you'll obviously get a significant jump. Or even if you compare it to the year 2021, because that was the year where most people were not even traveling because of the pandemic. So when we see when we make a comparison, it's very important that you take your base year or the base period correctly. Which is why when the company states that when compared to the year 2000, I mean the quarter of 2019, the similar quarter for next quarter when Delta Airlines reports their earnings and they're comparing it to the same quarter of 2019, they are expecting 97% of the sales to be recovered. So, which is a big positive. And they are also expecting their revenues on a quarter basis to, in fact, rise double digits. So, keeping all of those aspects in mind, Delta Airlines actually the stock performed very well after their earnings were out. Now, let's understand. So, obviously, we've already seen the kind of impact on earnings can have on the stock, but let's actually look at the numbers also. So, we had Netflix, which also reported its earnings this quarter, and the company, in fact, reported an EPS of $3.59 versus expectations of $2.89. If you can see over here, the orange bar denotes the actual EPS, whereas it performed way outperformed your your estimates. On a quarter-on-quarter basis, also the jump was significant. On a year-over-year basis, also the jump was pretty decent. So let's try and understand how do you think Netflix fared on their earnings. Um, just a second, I shall share the stock, the poll as well. So, how did Netflix react to the earnings? Did it gain 10%, gain 15%, it fell 15%, or it fell more than 25%? What do you think was? I'm sure most of you all were tracking the markets and must be aware as to what happened with Netflix. So let's try and understand. All right, we've received majority of the responses. Um, well, hardly. less than 20% feel that the stock gained, whereas the remaining 80% so far feel that the stock actually fell after reporting, you know, positive earnings as well. So, of course, for those who are already tracking other markets, I'm sure they are aware that Netflix actually fell more than 25% after the company reported its earnings, which is why we were talking about that just beating the expectations are not needed and are not enough. A lot of weightage and importance is also given as to how the company is expected to perform in the upcoming quarter. So the reason why Netflix fell on its earnings is that the company said that they're forecasting the global paid subscriber loss of 2 million for the second quarter, compared to a consensus where they were expecting a 2.5 million addition. So given that the subscriber growth is falling drastically, the stock was heavily punished, and we saw the stock take a great beating. So there were various factors that were shared out there. I mean, of course, Netflix has been facing rising competition. We have Disney, many other channels out there which are streaming content as well. So the competition has increased drastically for Netflix. Apart from that, there are talks about a global slowdown, and most importantly, many people have been sharing their passwords. So the new subscriber growth for Netflix has come down drastically. Now that has been a major concern for the markets, and if you can see the kind of impact that the earnings of a company does have on the stocks, Netflix actually fell by almost 30% after its earnings, 35% once the company reported its earnings. So the fall was significant from close to 350, it fell down to 225. So this is the kind of impact that a stock, that a earnings will have on the stock. Of course, the jumps, we've seen such crazy positive upsides as well, especially when there's a news of, during an earnings, if a company reports that they've accepted an offer or a bid from another company, which is viewed as positively by the markets, then we see such massive movements on the upside as well. So now that we've seen all of these earnings, how to read an earnings report, it's important that we also, from our end, we on a regular basis, Century does roll out. Just a second, we have some. Okay, can you all hear me? Am I audible? Because there's someone stating that I'm not audible as well. Can anybody just confirm if I'm audible? All right, fine. Perfect. Great. Thank you so much. Okay. So now I have been talking since long that, we need to compare the earnings with the Wall Street estimates and so on and so forth. But a good question that could have popped up was that where can we see these the Wall Street estimates or the consensus estimates. So on a regular basis, now this information is available out there online as well on NASDAQ and many other websites out there. You can go and check this information. But from our end, Century Financial regularly will share the earnings calendar. We do this on almost a weekly basis. In periods when there is a lot of companies reporting their earnings, then probably we'll share the earnings calendar for 2 to 3 days, because we have a bulk of companies reporting their earnings. Now, this is one such time wherein we have multiple companies reporting their earnings this week. Now, I'll just show you how the earnings calendar looks like at Century Financial. Right. So I'm hoping you can see my screen. Now, when it comes to the earnings calendar out here, okay, I'll just zoom in a bit. So when we look at the earnings calendar, for example, we can see there are multiple companies reporting their earnings in the coming week. This is just for a period of 2 days from 28 to 29, and we have so many companies. We have Apple that is expected to report. We also have Mastercard that is expected to report between 28 and 29. So this is the name of the company. We have the the date when it is expected to report. Then we have something called as before market and after market. So companies always will either report before the market or after the market. They never report when the market is on and when it's live. The earnings will always be either after the market closes or before the markets open. So Mastercard is expected to report before the markets open, and we have an estimate, earnings per share estimate. This is where you can see the estimate is forecasted to be 2.2, and if your earnings per share comes in above this number, and if the guidance is also good and other parameters are also good, then we can see the stock doing well. Now, implied volatility is basically it's a percentage, and we try to see how volatile the stock will is expected to be around its earnings. So generally, we can see a 4% move up or down when Mastercard reports its earnings. Then we have the sector. We also have the current price for Mastercard when this was shared. We look at the 52-week high for the company and the 52-week low. And we also looked at what is the average of Bloomberg target price and how many analysts out here are recommending to buy the stock, hold the stock, or sell the stock. So there's a great amount of information that is available on our earnings calendar. You can access, and in your RMs or in your consultants can share the same with you as and when requested. We send them out regularly, so you can just contact your RMs for the same. Now, so moving on, this is how the earnings season so far has been. We've had 80%, 20% of the companies so far who have already reported the earnings, and 20% of S&P 500 basically, which is a major index for the United States. It tracks 500 largest companies by their market cap. So they have reported 20% of such companies have already reported. That is 35 out of 500. Now, 80% of these companies have already beaten the earnings estimates, whereas 77% of these companies have beaten the revenue estimates. So if we can look at on the next slide, when I said 20% have already reported, out of these 20%, 80% have reported above expectations. So their EPS has come in above expectations. Historically, the average, 5-year average, has been 77%. So if you look at it from that perspective, this time more number of companies have beaten the expectations, which is a good sign. Now, when it comes to the magnitude of the positive surprise, on that particular front, we have not done really well. So 8.1%, I mean, of the companies that have reported their earnings, the surprise has been 8.1%, whereas the historical average has been almost 9%. So on that front, the magnitude of the surprise has been lower. But having said that, almost 80% of the companies have reported a positive earnings. Now, coming to the most important segment, and this is something that Century Financial has created. It is their product. It's something called as the price action analysis. Now, when we do a price action analysis, is basically we are comparing how the stock has performed historically around its earnings date. And so of course, this can be done by you individually as well, wherein you can actually go back and look at how a particular stock has performed in any given year around its earnings date, and compare the performance year over year and see how does the stock move on its around its earnings. But this is something that is one of Century's unique products, and you'll not get it out there. At least I'm not aware of anybody else in the market providing such a kind of information. So allow me to share the flyer with you. Just give me a moment. So if you could just confirm that, can you all see the price action for JP Morgan and Delta Airlines on your screen? Okay. All right. So this is the just a second. All right. So like you can see, this is the price action flyer for JP Morgan and Delta Airlines. Now out here, what we are trying to say, what we've done is we have seen, uh, just a moment. Sorry, allow me a moment. So hopefully you all can now see the. So, if some of you can now just share a thumbs up. I'm sorry for the glitches, there's some technical issue. If you all can see the screen, it would just give me a thumbs up. It would be nice. All right. So let's get started. Now, when it comes to, we have two companies over here. We have JP Morgan and we have Delta. Now, let's first stick to JP Morgan. What we have tried to analyze over here, like I said, we'll be analyzing the historical movement of a stock price around its earnings date. So JP Morgan is expected, I mean, was reported already on April 13th. Now, what we have done is we have seen historically when the company has reported their earnings, if you bought the stock one day prior and sold it a day later, how did the stock price react on the earnings? And we've done this for every Q1 in the last 10 years. So we are doing a year over year comparison. So Q1 will be compared to Q1 itself. So if you can see every year I mean, in the year 2021, JP Morgan lost 1%. In the year 2020, JP Morgan lost 8%. In the year 2019, it gained 3%. In the year 2018, it lost 3% again. So on an average, the stock has lost almost 1%, more than 1%. If any investor would have bought one day prior and sold one day after earnings. and the probability for such a loss was almost 70%. Here you can see the gain of the probability of a gain in price is 30%, which means there's a 70% chance that the stock will fall on its earnings. Now, on the other hand, we've seen what is the performance of the company after the earnings. So if like over a period of 2 weeks following the earnings, that is from April 14th to April 27th, how has JP Morgan performed? So if you can see on an average, the stock has gained almost 1.6% on its earnings, and the probability of a gain is 80%. When I say 80%, so out of 10 times, there have been only two such quarters, that is in the year 2018 and in the year 2015, when the stock actually fell and did not rally. So this is merely a historical analysis of how the stock performed. When we are looking at this, we are not looking at how did the company report, did it beat the earnings forecast. All of that is not taken into consideration. This is merely how the price of the stock performed, how the stock performed on the earnings. We are not looking at as how the company reported their earnings. Was their revenue higher? Was their EPS lower? None of this is being taken into consideration. Of course, the prices do incorporate this, but the price action flyer out here is merely concentrating on the price movement of the stock. So, I mean, when we are taking a trade like this, indirectly, when we are taking a trade in a particular stock, irrespective of the price action flyer, generally when you go online and you check, okay, the company is expected to report 2.3%, and sorry, allow me a minute. Yes. So we know that the company is expected to report 2.3%. I mean, their EPS is expected to be 2.2, and you just buy the stock on those projections. You've done your analysis, you've done your research, and you go ahead and you buy the stock. So indirectly, you are speculating because you don't know if the company is actually going to report a positive number or a positive surprise or no. At the same time, when you take a price action trade based on the flyer, again, we don't know how will the company report, will the earnings be really good, bad, we don't know anything. But in this case, the speculation is more of a calculated risk because we are seeing how the stock has performed historically around the earnings. So here you at least have a probability attached to it. I can see that JP Morgan has a 80% probability of rallying after the earnings are out. So in this instance, in fact, there is a 70% chance that the stock may actually fall on earnings. So when I see that there's a 70% probability that the stock will not do well around the earnings date, at least I may not go ahead and buy the stock. There are others who are risk takers out there who may actually end up shorting the stock looking at this kind of an information. But when you have an information like this available, you may not go ahead and at least buy the stock. So now let's understand. So this was how JP Morgan was expected to perform. So let's see if it actually, if the stock actually did perform according to the price action flyer, or it did not do well. Let's take a look at the demo session as well. So we'll go to the trade room app. So can you all see my screen, the trade room screen? All right. Now let's look at JP Morgan. So make it on a daily basis. Now, if you can see, and it came to the flyer, 1 second. So our flyer basically said if we bought on April 12th and sold on April 14th, the stock would have actually resulted in a loss. So April 12th, the closing price of JP Morgan was 131.49. If you can see over here, my cursor also at the top, you can see the closing price. So the closing price for JP Morgan was 131.5. And on 13th, when the stock opened, it opened gap down, it opened lower, and it opened directly at 127. So from 131, the stock opened $4 lower, which is nearly, I mean, it already opened 3.5% lower, 3.3% lower. And our target was, I mean, the average pull down that we were expecting was 1.1%. So if any individual would have taken such a trade, the trade would have resulted in a profit wherein the stock opened gap down and it opened lower. On the other hand, we said that according to the historical analysis, if one bought the stock at the closing price on 14th April, so the closing price, this is, so I'll just close this for you so that it's easier to see. So the closing price on 14th was 126. You can see out here as well. I'll just, one second. Yeah, if you can see the closing price out here on 14th April was 126 and the stock actually rallied by more than 5%. The high for the stock was almost 133.5. So you made almost $6, which is like nearly 6% in a span of 2 to 3 days. So, I mean, obviously, we wouldn't have waited for 6% because our average returns that we were expecting was close to 1.6%. So you would have exited already at a gain of 2% because you're making 2% in a span of just 3 to 4 days, which is huge. So this is how we trade a price action. Now let's look at Delta Airlines, another example. Now Delta reported, I'll just share my screen again for Delta Airlines, just a second. Now, for Delta Airlines, if between 12th and 13th April, the company is reporting on 13th April, all the trades over here are based on closing prices. So the company is expected to report on 13th April. Based on that, we've given the performance of how the stock reacts one day prior. So if you buy one day before the earnings and hold it till the earnings date, the closing price, or if you hold it for a week, what happens to Delta Airlines? This is what the flyer is talking about. So over here, the flyer is basically saying that there is a 60% probability that Delta Airlines will gain on earnings, and there is a 70% probability that the stock will gain if it is held for over a week. Now, it's important to understand by no ways these flyers are giving you, it's not a recommendation to buy or a sell. It's important that your risk factors are taken into consideration and you discuss with your consultants before taking these trades. Your risk profile, your risk appetite, everything, the quantity of the trail, everything needs to be discussed with your respective RMs or your consultants before you take the trade. So this is just a historical representation of Delta Airlines around the previous quarters or for their respective stocks that we keep sharing on a day-to-day basis. So this is how the stock has performed historically, and it's important to understand that past performance may not be a guarantee of what will happen in the future. But yes, this does provide you a reasonable idea of how a stock will perform during a certain quarter. Now, the idea and the logic behind all of these trades is that a simple example, like I gave you for Apple. Now, Apple comes up with its iPhones in the month of September. So it's almost very likely and very possible that every year in the last quarter ended December and in the quarter ending September, you generally see Apple sales do really well. So and the net income also ends up doing well. So the stock price automatically for the period of September ends up going up, and your stock based on the seasonality parameters ends up doing well if you trade around the third quarter earnings for Apple. Now likewise, if you look at, for example, Netflix, During the holiday season, Netflix generally has a tendency of seeing significant subscriber growth. So, in the last quarter, in the quarter ending December, Netflix generally has a huge subscriber growth, or many audiences are sitting back at home watching Netflix. So, the usage of Netflix is very high. So, during that period, generally we tend to see that Netflix does well. The stock ends up doing well. So there are seasonal reasons or factors responsible behind the reason why a stock ends up doing well in a particular quarter based on its earnings. But that may not always be true. So it's very important that we manage our risk well. Uh, so this is just a historical representation, and when you're actually speculating on earnings, this gives you a more calculated risk. It gives you a picture in advance that there is a 70% probability that Delta Airlines will actually do well. The stock will do well after the company reports its earnings. So you have to buy one day prior to the earnings in this particular, according to this example, and and exit on the April 20th. If this was done for 1 week, what is the kind of gains that you could have expected? On an average, it's 4%. The probability is 70%. Whereas the maximum loss, it has also fallen during such period. It has fallen by 7%. So almost everything, your risk and everything is provided to you out here on the flyer. Now let's look at how the stock performed between 12th to 20th April. In the meantime, if you have any questions, please ask. Can you see my screen? All right. So, all right. Now, this is JP Morgan. Now, like you can see for JP Morgan, the stock was, no, now we need to go to Delta Airlines. I'm sorry. Right. Now, for Delta Airlines on 12th April, the closing price was, it was 38.6. If you can see, the date is available on the top of the screen, whereas on the right side, you can see the price. My cursor on the top, you can see the date. On the right side, you can see the price. So on 12th April, the stock actually closed at 38.6. Now, directly when the company reported the earnings before market on 13th April, the stock actually opened gap up almost by 4 to 5%. 4% the stock opened gap up, already kind of achieving our targets. And if you held on till April 20th, the stock actually rallied by 12%. So this is how Delta performed around the earnings date once the company reported its earnings. Likewise, if I were to share another example and another flyer with you, please come up and with any questions that you have, so that in case if this is not clear, we can address your doubts or questions if any. Now, allow me a moment once again to share my screen for. All right. So this is yet another. We have Wells Fargo and Goldman Sachs. Generally, whenever the earnings season starts, we'll always see banks are the first ones to report their earnings, and then we have major tech companies that start reporting. So this week we have a lot of tech companies which will be reporting their earnings, and we have earnings flyers for that as well. In case if you are interested, you can request your respective RMs to share the same. Now, coming back to Wells Fargo, so over here we've seen Wells Fargo is expected to report on April 14th, and we've tried to give a picture as to how the stock performs between one day prior and one day after the earnings. And if you bought one day after the earnings and held it for almost 2 weeks. So we've given a performance of the stock for a period of almost 2 weeks after its earnings and for a day prior to its earnings. So a day prior to its earnings, there's a great probability for Wells Fargo to fall. So we can see the average fall is expected at around 1.8%, and there is a 70% chance that the stock will fall before its earnings. I mean, if you buy it, if you bought the stock before the earnings and held it after the earnings, there is a great chance that you would have lost the money. So, in this situation, any client, when you see an information like this, it might be sensible to not take a trade and not buy the stock. On the other hand, there are many who would prefer to take a short trade. But all of these, like I said, it's important you understand your risk factors and take the trade only after consulting with your respective advisors or your consultants and so on and so forth. Now, between following the earnings, the next 2 weeks, generally, Wells Fargo tends to do well. And in the last 10 years, there has not been a single year where Wells Fargo has actually lost any money. In fact, the stock has gained if in the 2 weeks following the earnings, and the average gain has been 3.3%. So there's nothing, there's nobody can guarantee, there's no 100% probability, and which is why over here, in terms of probability, we've not mentioned anything because there's always a chance that going forward, I mean, in the upcoming quarter, the stock does not meet up to the expectations and it falls, or there could be any other risk attached to it. So, but generally, Wells Fargo rallies after the earnings. And likewise for Goldman Sachs, initially it is expected to fall and then expected to rally. So quickly, let us take a look at the demo account and see as well if the stock actually performed according to the expectations. So coming to Wells Fargo, I'll just search for it. Yes. Now, this is Wells Fargo. Make it on a daily basis. So now 15th April was an off in US markets. It was Good Friday. So the trade would be only for 13th to 14th April. Now Wells Fargo, the closing price on 13th April was 48.59. Okay. So 13th April closing price was 48.59. And when the stock opened on 14th April, it directly opened at 45.8. Yeah, so if you can see, the stock actually fell by almost 5.5% when it reported its earnings. So the first part of the trade met expectations. Now the second part of the trade was that if you bought the stock, then there is a generally a probability that Wells Fargo will perform well in the next 2 weeks. So on an average, if you see out here, now because 15th April was an off, we'll buy the stock, we'll have to measure the performance from the opening price on 18th May. So from 18th May till 20th April, the high was already above the target of 3%. So the stock actually rallied by almost 7%. So the average expectations were 3%, and the stock went up by almost 7% before correcting again. In the last 2 days, there has been a crazy sell-off in the markets amid rate hike expectations. But despite all of that, the stock actually, met its average gains already and rallied by more than 3%. Now, likewise for for Goldman Sachs also, we had a similar performance from 13th April. If you can see, the closing price was 322. The stock, closed at, in fact, it initially rallied and did not go in line with what we were expecting. However, on the closing basis, the stock closed slightly marginally lower. So, in that regard, the first trade of Goldman Sachs did not really beat expectations. But the second trade, wherein which involved a forecast where the stock would actually gain after the earnings. So on 14th April, the closing price for Goldman Sachs was 321, and whereas from that date onwards, we've seen Goldman Sachs has actually significantly rallied by almost more than 7%. So when a stock is rallying by 6%, 7%, 5% in a span of 2 to 3 days, that is something that generally you expect these kind of returns in almost a year. So you're trying to you're during an earnings season, that is the kind of volatility that we see in the stocks, which is why we've held this session to understand the importance of earnings as well. Now, so likewise for Netflix as well, we had predicted that there is a 60% chance that the stock will fall on after its earnings, and as we can see, the stock drastically was sold off. It opened nearly 30% lower, and in fact, since its earnings, the stock is down by almost 40%. Now, but not every trade will go correct. There are times wherein the trade doesn't move in the correct direction, and it's important you have a look at that as well. So, if I were to show that screen with you quickly, so we had Netflix and IBM. Now, IBM, we were expecting the stock to actually underperform. So if you can see previously, Netflix, if you can see for IBM, the stock generally does not do well if before its earnings, and the stock on an average loses close to 4.6%. But this time on its earnings, the stock gained, and we had a if any person would have shorted this particular stock, he or she would have made a loss of 4 to 5%. So what we can see over here for IBM, the trend could be changing, and maybe the stock has now started picking up because the company has started doing a lot of positive aspects as well, and they have a new CEO. So when things are changing for the company, there's a good chance that maybe this could be a trend changer. So IBM, in fact, rallied on earnings this year, and it continued with its rally, which we had forecasted according to the price action report. So quickly, I will show you the chart for price action for IBM, and then we'll call it a wrap over there. Um, Sorry, once again. Right. So if you can see over here, we have IBM, which stated that from the closing of 19th April, the stock was actually expected to open lower on 20th April, but it opened 4% higher. So that would have hit your stop loss. This trade went in the opposite direction. But beyond that, if you bought on the closing of 20th April in line with the price action, the stock rallied and met with the expectations. So the stock gained almost more than 3% before correcting again. So not necessarily all the price action trades will go correctly, and which is why it is important that you consult with your advisors and your consultants before taking any such trade. Thank you for attending today's session. I will call it a wrap, and hopefully we'll see you all in the next session. Thank you once again.